Good. And let me share the screen. And the slides. Okay, so before I start, please don't see this as a regular lesson. So activate your microphone and stop me and ask me questions whenever you want. So it's very less formal. In order to look at the chat, I have to stop sharing and have to go back and forth. So again, since this is absolutely not a formal lesson, please just interrupt me with a microphone for anything you want to ask and add, and so on and so forth. Okay? Good. So, all right. So this slide here is very useful when you have to think about the 4 financial statements. As you may know, there are 4 of them that are required to be presented and filed. And the reason is because each financial statement conveys and provides different kind of information. Usually in the preparation, let's start with the income statement. So by preparation, I mean, so what happens is you have a bunch of economic real transactions that happened. These transactions could be the companies sells products for a given amount. This information has to be translated and incorporated into the financial statements. How? Well, through a couple of steps. Journal entries first, and then T accounts next. And then at last, all the T accounts from the bookkeeping system gets incorporated into the different statements. If you want, when we finish this kind of refreshment, a general refreshment about how to account, how to recognize the assets, the current and non-current, tangible and intangible assets, we could also have a very quick look at how the bookkeeping works in case you have some doubts. This is also an opportunity that I can easily give you in a short class like this one over the next days, weeks, whenever we have time. So let's say we have the real transactions, the sale that happened. We also can incur in expenses. We are paying our employees. Things that happen in reality gets incorporated into the journal entries, the T accounts, and finally come here into these financial statements. Of course, each financial statement requires some of the T accounts to go, some T accounts here, some T accounts there, and that's different. There would be a different lesson. What I want to show you here is how, starting from the income statement, the bottom line of the income statement is needed in order to complete the statement of changes in equity. The bottom line of the statement of changes in equity, which is the end of the year shareholders' equity, will flow into the balance sheet under the shareholders' equity section. And on the other hand, the statement of cash flow provides information regarding the cash available. So that line as current asset that goes in the balance sheet, that information there is computed overall in the statement of cash flow. So as you can see, income statement, statement of changes in equity, and cash flow statement all flow into the balance sheet. This is also can also be seen because, well, income statement, statement of changes in equity, and cash flow statement are computed on a yearly basis. Every year, you start from a brand new, from scratch, brand new statement. While the balance sheet keep information from the very beginning, from the very foundation of the enterprise or the corporation itself. So every year we will have some net income or loss that will flow into the balance sheet, and the balance sheet keeps track of all the information from the very beginning. Okay. Then remember that when we talk about the fundamental accounting equation, is the assets are always equal to liabilities and equity, always. If they're not equal to liabilities and equity, there's only one reason why this could happen. There is only one scenario when the assets are not equal to the sum of liabilities and equity. Can anybody tell me when this is? When the fundamental accounting equation does not hold? Does anybody know when this does not hold? You're still thinking? Well, the only reason why the accounting equation does not hold is because you made a mistake. It really does hold, always. Okay? So the accounting equation always holds. If it does not hold, if the balance sheet does not balance, it means that someone has made a mistake. Okay? And it has to balance because of the very nature of the double entry bookkeeping. So the moment the real economic transaction goes into the financial system, has a double nature. And if you know a little bit about double entry bookkeeping, then you know what I'm talking about. In case not, we can discuss this another time. But by the very nature of the system, of the process, the balance sheet has to balance. And then remember that the income statement is the final product is the net income, the profit or loss. Okay. So this is another graphic to show you and hopefully to help you memorize where everything goes. So the bottom line of the income statement, the net income, is reported in the statement of changes in equity. Think about the statement of changes in equity as a picture that focuses on, that zooms in what happened during the fiscal year within the equity. So the statement of changes in equity is exactly what the title gives. It tells you the changes in equity, what changed under the shareholders' equity section from the 1st of January until 31st of December or whatever fiscal year we have to report. So for instance, in the statement of changes in equity gives you the beginning equity, which is exactly the end of the year equity, because we assume that overnight nothing happens. Any equity issuance, any share repurchase, so any increase or decrease in shares in equity, net income, cash dividends, all computed give you the ending equity. The cash flow statement that is divided into 3 blocks to highlight the net cash that arises from operating activities, investing or financing activities. The sum of this net cash gives you the net increase in cash, which is summed to the beginning of the year cash balance to give you that very same number that goes under current assets, cash and cash equivalents in the balance sheet. The statement of changes in equity, in turn, gives you the ending equity, which has to be equal to the total shareholders' equity computed in the balance sheet. Okay? So 4 statements that 3 of them, the ones computed on a yearly basis, income statement, which is also called profit and loss, especially in the US. So income statement, cash flow statement, and statement of changes in equity, they all go in the balance sheet. You might also hear about the other comprehensive income, which is usually reported together with the income statement. We will see that some items, especially in some revaluation cases, some items must be reported in the other comprehensive income. The general idea is that in the income statement, we want to give specific information and detailed information about how the company was able to arrive at the profit through its normal operating activities. That's very specific. So in order not to mislead investors and users of the financial statements, some other items, some other gains, some other increases that might happen during the year has to be reported on a second separate statement, which also will go and will flow into the company's equity. Simply, it's reported on a separate statement. Okay, then retained earnings. Okay, in case you don't remember, how do we compute retained earnings? Well, we usually start with the beginning of the year retained earnings, to which we add net income or subtract loss in case it was a non-profitable year. We subtract the dividends paid, and this is how we get to the ending retained earnings. The idea of the retained earnings, if you have a look, is the earnings of the year that the firm decided not to pay out as dividends to its investors, to its shareholders. If you see, you have the net income minus the cash payouts, the cash dividends, and this is how we get to the ending retained earnings. Okay. All clear?
Yes.
Good. Is this new? I know you cannot answer this because so the answer should be absolutely no. This should be clear for everybody. I hope that it's a useful summary. Otherwise, if you feel that this is old news, please tell me, and we will continue. We will go a little bit faster. Okay. Good. So for today, we will start looking at the assets. I've chosen this topic because this is what we've been looking at during the course. Lots of revaluation we were discussing about assets at fair value and how this topic comes up in the consolidation process. So in order to help you a little bit, we're going to have a look at the non-current assets, the tangible, property, plant and equipment, and other assets which are intangible assets. And we will focus on how to account and recognize these type of assets, not in a consolidation scenario, but as single entity accounting. So, property, plant, and equipment, which is abbreviated in PP&E, are fixed assets, non-current, and long-lived assets that are tangible. What does non-current means? So non-current means that they are expected to be used during more than one accounting period. If you go back, you see that current assets are the cash and cash equivalents, accounts receivables. Account receivables are what we expect our clients to pay us for service and goods that we as a company have already delivered. So this is what the clients owe us. Inventory, prepaid expenses, and current investments, all these are expected to be settled within the accounting period. PP&E and intangible assets usually are non-current, so we expect to use them for longer time frame. In order to account for the PP&E cost, we use a technique that is called depreciation. And the definition of depreciation is the allocation of the PP&E over its useful life. What's the useful life? Well, imagine that you buy a computer. You expect to use it for 3 years. That means that you expect this item to be useful to you for a year. 3 years. In order to account for its cost, you allocate the cost of the computer, in our example, over these 3 years. The accumulated depreciation is the amount that has been allocated over the years, the total amount. And that gives you the carrying amount, which is also called the book value, which is the difference between the asset original historical cost and its accumulated depreciation, which is the sum of all the depreciation expenses. So if you have a computer that you bought for 3,000 euros, you're going to use it for 3 years. It means that each year in the income statement, you would have a depreciation expense of 1,000. And after the second year, this accumulated depreciation will go up and the carrying amount will go down. I will give you some detailed tables with all these depreciation scheduled that can also change according to the method of depreciation that you're using. That does not necessarily have to be a straight line. Okay, it could be accelerated, it could be double balance, that could follow the units of production instead of a straight line. Then, also as non-current assets, we also have intangible assets. So PP&E, property, plant, and equipment, is tangible. It's physical. You can touch it. It's a land, it's a building, it's a machinery, it's a piece of equipment. Intangible assets are non-monetary. They're not expressed in fixed or determinable amounts of money, and they do not have physical substance. The accounting for intangible assets is similar in nature to accounting for PP&E, with the exception of goodwill. And you already see that goodwill gives you a lot of problems, a lot of issues, especially then in consolidation. When we discuss and we account for intangible assets, we say that we use amortization, which is exactly like depreciation, the allocation of intangible assets over its useful life, except for that in the English language, we call it amortization. Examples of intangibles are, except for the goodwill that you are already quite familiar with, then we can have all different sorts of intangible assets, such as software, patents, licenses, trademarks, customer-related intangibles, brands, information system, distribution rights, and so on. Okay? Other non-current assets can be construction in progress, which is all the sum of the cost incurred for construction of the PP&E or intangibles. And you see here, you find the accounting standards that deal with the specificities of this other non-current asset. We can have investment properties, we can have biological assets, and so on. I will not go into further detail here. I just present you with the overview. So if you come across specific item, then you have the reference to the accounting standards to have a look more in detail. So in this table, you have the asset account and the related expense account. The asset is always placed in the balance sheet. In the income statement, you will find its expense, its related expense. So for instance, under property, plant, and equipment, you can find freehold land, which is land that it's held in perpetuity, which does not lose its value with use because you don't have a contract with an expiration date. So there is no related expense in the income statement. On the other hand, leasehold land, which is the type of land that you have a contract with, let's say, the municipality, the state, which grants you the right to use the land for a specific limited number of years, which could be also 100 years, but still it has an expiration date. So you need to depreciate for that piece of land. We have buildings, machinery, equipment, that needs to be depreciated, and in the income statement you will have a depreciation expense. Furniture and fixtures, land improvements also are depreciated. Natural resources, we say that we use depletion, which is a different word, but the process is exactly like the depreciation system, except that the word is depletion. And then we have the intangibles that are divided into intangibles with a finite useful life that need to be amortized, and intangible with indefinite useful lives that do not require any amortization. So, when do we recognize an asset? Recognition of property, plant, and equipment, and intangibles. Two criteria has to be met. The first one is that it is probable that the future economic benefit associated with the item will flow to the entity. So we can recognize an item, the property, plant, and equipment, and intangible, if it's probable that will give a future economic benefit to the firm. What does that mean practically? What it means that it is probable. It means that it's the result of an estimation. So again, it does involve a certain degree of subjectivity. Second, the cost of the item can be measured reliably. So we have to be sure, or enough sure, regarding of how much the cost of that item is. These two criteria represent a big problem for some items. Let me give you an example. So you buy a machinery that produces the products that you're selling. It works, it's functioning. You have an invoice with a price that you paid for acquiring that asset. So the second criteria is met. And since the machine is operating and it's functioning, it is quite probable that we'll be able to produce the X number of products that you have in mind. So, for instance, with this machinery, this tangible PP&E item, both criteria are met, and you don't see any problem here with the initial recognition. Okay, let me give you another example. Since we are in this particular situation, let's get the vaccine example. So you have a vaccine that has not been tested and does not have the FDA equivalent, the approval of the government approval for its use. What do you do with this prototype? Are the two criteria met? Are you sure that it will lead to a future economic benefit? How can you measure whether it's reliable? How can you measure whether this economic benefit is probable or not in the future? You can see that for some items, the initial recognition is not that easy, because sometimes these two criteria are not met. But why is it so, allow me, important to be able to initially recognize an asset? What happens with the cost of the asset if it cannot be recognized? This is a question to you. So, anybody? What happens when we can recognize an asset? Where does the asset go? In which statement? I'm not going to talk for an hour straight. So this course, this lesson here is thought, so you can also speak up.
Professor, could you repeat the question, please?
Sure. So we are talking here about the initial recognition of an asset. Okay. We said that if it meets these two criteria, we can recognize it. So what does that mean? We recognize an asset. It means that we can write it under which financial statement? Where does it go?
Balance
sheet.
Great, balance sheet. Okay. So if an asset is recognized, it goes in the balance sheet. If it goes in the balance sheet, then what do we do? Well, we have the depreciation, right? The depreciation expense, and all that we've seen in the earlier slides. What happens if we cannot recognize it? So if it does not meet these two criteria, what happens?
We expense it yearly in the income statement.
We expense it yearly. And usually, what's the effect on the net income?
It decreases a lot.
It decreases a lot.
It is.
Right? So on a general rule, it's always better, it makes the income statement look nicer if we can recognize an asset instead of having to expense everything. Okay? So this is why it's always important, and this is also why there were, if you look at in the accounting history, the accounting frauds that have been made on especially this topic here. Items that did not meet the criteria for initial recognition were recognized in order to make the company looks healthier and more profitable than it was supposed to. Okay? So this is why I'm stressing so much about these two criteria. They're not just abstract words, because in practice, they translate in huge differences about how the company is presented. What else? Then, yes, the cost that can be capitalized when the asset is initially recognized includes also its purchase price, import duties, discounts, and so on. And also any cost that can be directly attributable to bringing that asset into the specific location and use. Okay? Again, this is just for your general knowledge, which items can be directly attributed. It means which costs can be capitalized and which has to be expensed. If you have a look, advertising costs, staff training costs, administration costs must be expensed. Okay? So, the depreciation, how does it work? We charge the depreciation expense to the income statement, and the cumulative amount is charged to an account that is called accumulated depreciation. The assets that you see in the balance sheet are reported net of the accumulated depreciation. The depreciation expense should reflect the depreciation based on the real and what we have at the end. It's called the stress on of production. So that able to reduce also expense here. You have example estimate the at the trap. Okay. The carrot. With this method here, instead of arbitrarily divided by the number of years that you expect to use the asset for, you are more specific in computing a revenue stream that the asset produces for the firm. So this is the idea of why we say that the depreciation system supports the matching principle. So the company should choose the depreciation technique, the depreciation system that better matches the revenue stream that the asset is able to produce. The idea is, well, we want to have a clean net income, right? This is what the matching principle is about. We have a revenue, we have some expenses, and we want net income that gives us a good picture of what's really going on in the firm. Unfortunately, with the depreciation expense, there is a lot of discretion going on because, well, we are relying on several estimations. We estimate the residual value. We estimate the useful life that we be using the asset for. We also use an estimation in choosing and picking the type of depreciation system that we want to follow. If we do things correctly, we pick each of these items, discretionary items and estimations, with the idea of giving to the investor a better picture of what's happening within the firm and give a good match of the expenses to the revenue. Then there is also another type of depreciation method. The accelerated depreciation methods are usually used well for it's a possibility that the tax authority might give the companies to, for instance, increase investments. You can see here why. If we have a look, this is a double declining. Well, because to get the depreciation rate, you divided 1 over the number of life in years and you multiply it by 2. Completely arbitrary multiplication. It's double declining, so you get twice as fast depreciation expense. If you see here, the depreciation expense in your earlier years is much higher, and then it decreases its amount towards the end of the useful life of the item. The effect on the net income here, well, you might argue that does not look so favorable to have a lower net income at the beginning. But you can think of one good reason why this could encourage investments on behalf of firms to have high expenses immediately that can, yes, decrease the net income, but also decrease the taxable income. So for the earlier years, as the taxable income is lower, also the tax expense is lower. And firms can be encouraged to invest more in assets that are allowed for an accelerated depreciation expense. Okay? This is one kind of accelerated depreciation. Again, the double declining. The percentages and the declining rate are arbitrarily chosen, and you can have different other types of accelerated depreciations, not necessarily this one here. But the idea is that the declining rate is given, and you compute the depreciation expense following this table here. Okay, so in this case, with the double declining, if you have a look here, the last year, to compute the last year depreciation expense can be a little bit tricky, because when you reach the end, or you go towards the end of the depreciation schedule, then you might need a plug amount in order to compute the last year depreciation expense that does not necessarily is, as with this case, the 40% of the asset carrying amount. So it's just a little bit more difficult to compute, but the technique is always the same. So as I said, the general idea is that we should be choosing the depreciation method that is more suitable for the kind of asset that we are using. So for instance, the straight line method is best for assets that generate the revenue evenly, while the units of production is better for assets that wear out because of its use. So it gives a better picture, a more honest picture to compute the depreciation expense based on the units that the asset is producing. The double declining balance, as other accelerated method, is best for assets that generate a lot of revenue at the beginning, and in the later years, the revenue stream decreases. Or, as I told you, is a technique, a tool that it's used in order to increase investments on a governmental level. As you see here, most of the IFRS companies use the straight line, while the other methods are much less common. Again, this is a very easy example to show you the effect on the net income. Here, it's a cash revenue, so there's no accrual to make it easier on the revenue, and it's the straight line versus the accelerated depreciation. Then you can see how the income tax expense is computed differently, and how this leads to an extra cash available just because of the depreciation method that has been chosen. Okay, this is a graph that shows you how the carrying amount decreases with time according to the different methods. The straight line is the straight line that you see, while the units of production is the one that varies on a yearly basis according to the units produced, and the double declining is much steeper at the beginning, and then it smooths out towards the end of the life of the asset. with respect to the depreciation amount, so the yearly depreciation expense, again, you see that the straight line gives a constant depreciation expense, while the units of production varies. And the accelerated depreciation is also much steeper at the beginning. So we have very high depreciation expense in the early years, and then it becomes more flat. Okay, so this slide here gives you a summary of what to do with any subsequent cost. So we looked at the initial recognition of the asset. We said that we can recognize it and write it under asset. That means capitalize it, depreciate it, and everything will look nice and clean in the income statement. We will have our depreciation expense. We will be happy, very happy, because it will not have a huge bad impact on the net income if it meets those two criteria. So we are quite certain that it will give us a future economic benefit, and we can measure its cost reliably. But what about subsequent costs? What shall we do? Shall we capitalize? Shall expense? Here you have a guideline. So, for instance, day-to-day services must be expensed. Replacement, on the other hand, replacement is recognized in the balance sheet. Of course, you de-recognize the replaced part and you recognize the new part. And at the bottom here, you find the general guideline. So the capital expenditure that increases the asset capacity or extend its useful life can be capitalized and not expensed. Anything else cannot increase the value of the asset in the balance sheet, but is entirely an expense in the income statement. Okay, so here is an example of what to do when during the asset useful life there is a change in estimate. Imagine that you're using a machinery that you thought you could use for 10 years initially, but then after 4 years you realize that it has still some value, it's still a good use, and you can extend its useful life. So the idea is very simple. You just do a new depreciation schedule the moment when you want to change the estimate and recompute the depreciation expense accordingly. Okay. So, is it all clear so far? Okay, so now you should be extremely familiar with the depreciation. Okay, I'm looking at the chat. Okay, so let me look at some questions. Elena asked, BS is expensed in the income statement. I don't fully understand the question. BS stands for balance sheet. It's expense in the income statement. So an expense goes in the income statement. I'm not sure what the question means. Alliance says that it's known upon purchasing the product and is straight line the most common method used. Yes, so straight line is the most common method used. And upon purchasing the product, yes, you choose. Okay, you do it just answering. Thank you. Good. Unfortunately, I cannot look at the chat while I'm sharing the screen. So you really do not disturb me if you speak up. Otherwise, I have to stop, look at the chat, and go back and forth. Great. So if everything is fine, we could either stop here and we can continue another day.
Hi, Professor Anna. Maybe I have a quick question.
Sure.
On the 11 slides, you said the professional fees can be directly attributable to the cost, but sometimes when I look into the financial statement, the professional fees will generally be expensed in the income statement. I mean, what kind of the professional fees that can be directly attributable in this in the PPE acquisition?
I think so. It usually depends on the type of contractor. I believe that is that we have, and professional fees that can refer to what I'm thinking. So since you can capitalize any cost that that you incur in to bring the asset to its final destination and final use. These are the professional fees that I would think of. Professional fees that relate to these costs that you see above in the slide. So cost of site preparation. So professional fees that relate to the site preparation, to the delivery, to the assembly, to the installation.
Oh, okay. So you can add the installation fees for professional service to the amount of the assets.
This is how I would interpret this, yes. While on the other hand, the advertising cost, professional fees related to the marketing and advertising, then no, needs to be expensed.
Okay, thank you.
Okay, is that clear?
Yes, clear.
Great. So what I also prepared in the slides is the subsequent measurement and the revaluation. Since I've been already talking for 1 hour, I would leave this to another day, if it's okay with you. According to your schedule, please answer. You can answer in the chat. Okay. So, perfect. So we can find another time. If you suggest also any day of this week, it's fine with me during the afternoons. How is your schedule looking? You have to write, guys. You have to tell me. What about Thursday afternoon? You have classes Wednesday to Friday. You have always classes, okay? Next Monday. How does next Monday look like? Monday is good? Great. Monday afternoon? Monday afternoon. Okay. Monday afternoon around 3. Sounds good? Perfect. Okay. So we'll meet again on Monday afternoon. Keep in mind that we will also have the regular lessons with me next week, but we will also see each other. Accounting curricula has math class on Monday afternoon. Okay, when does it end? Oh, you have math class at 4:30. Okay, so you want me to maybe anticipate, let's say 2:45, so 2:45. It's 2:45 good? It looks like an auction. Is 2:45 good on Monday? Oh no, it ends at 4:30. We can see each other 4:30, 4:45, so 4:45. Monday? Is this good? Okay. So next Monday, 4:45, we will look at the subsequent measurement of property plant equipment. You might want to have a look at the slides if you have never heard or an impairment test. So have a look at the slides if you are really struggling. So you can ask me some question next time. Of course, you can ask me anything regarding any part of the previous slides. If you want, I can also upload some exercises with solutions that you can practice on, even some more basic exercises with a little bit of double entry bookkeeping. Yes. Okay. And then just one last question would you be interested also in a quick refresh on bookkeeping? There might be some journal entry that come out in the exam with the consolidation. Would you like a refresh on a much easier single entity bookkeeping before you deal with the consolidation? I thought so. Okay, I will also organize that. So see you next Monday. And will you record next Monday lecture? I always record the lecture. And if I don't, remind me. But I can always record. That's not with solutions, of course, with solutions. Okay, great. Bye, guys.